First of all, I just want to welcome everybody to the webinar today. The webinar is titled Tax Planning Strategies for Plaintiff Attorneys in 2025, How to Reduce Taxes and Build Wealth. So we're so glad you could join us today. Thank you for taking some time out of your schedules to explore some strategies that hopefully can help you save a lot of money and build some lasting financial security. Just for those of you who don't know me, my name is Greg Maxwell. I'm a settlement planning attorney and a certified financial planner and one of the co-founders of our firm, which is Amicus Settlement Planners. So I've spent my career, the last 20 years, working with primarily plaintiff attorneys and plaintiffs to help navigate the complexities of legal settlements from the tax, financial planning, and government benefits planning side of a legal settlement. So excited to share some strategies with contingency fee-based attorneys today that have helped attorneys save thousands, if not hundreds of thousands of dollars in taxes. Just a little introduction about our firm. At Amicus Settlement Planners, we specialize in helping plaintiff attorneys and their clients kind of deal with these issues. So grateful that you can be with us. We work with over 150 law firms nationwide to do tailored tax planning for their clients and also for attorneys like yourselves. So today's webinar is going to be part of an ongoing, what we call Amicus webinar series, where we're going to discuss topics that are of particular interest to plaintiff attorneys and your clients. So before we dive in, just a couple of quick housekeeping items. If you can, please try to make sure your devices are muted so that we don't get any disruption through the Zoom. If you do have questions during the presentation, what we found is easiest is if you'll just drop those questions in the Q&A box, and then we'll try to address those at the end. So let's go ahead and get started. First, I want to introduce our co-presenter, Dan Maxwell. He is also an attorney, and he's going to be discussing, we're going to kind of be going back and forth as we discuss these issues today. So, all right, we'll go ahead and get started here. First of all, the goals for this presentation, what we hope to do is we hope to show you the exact strategies that we have used and that we use, every day to help plaintiff attorneys save hundreds of thousands of dollars in income taxes. And to teach you why these strategies are really the most effective way for you to be building wealth and reducing your income taxes. So if you are a contingency fee-based attorney, then this is where you want to be. If you're paying more in income taxes than you want to pay, if your firm's cash flows are irregular, we know that for contingency fee-based practices, they can often, swing wildly from year to year. If you're looking for a better way to save for retirement, and if the solutions that your CPA and financial planners have for you aren't particularly appealing, then hopefully you'll find some value in this presentation. As I mentioned, Dan and I will be presenting today. We've published articles or been referenced in various magazines. We do CLEs for lots of different trial lawyer organizations. Some of those publications are listed on this slide below. So the first question that we wanted to answer that we get a lot from plaintiff attorneys that we work with is why haven't I heard of these things before? And I think the main reason is that most financial advisors and CPAs don't work specifically with contingency fee-based attorneys. They're working with doctors, dentists, business owners. And so the strategies that we cover today are completely unique to a contingency fee-based attorney and only available to you if you practice that kind of law. So because your financial advisors and CPAs are unaware of them, you end up paying more in taxes than you need to every year. Because we are going to be talking about tax planning and taxes, we just want to, of course, start with a disclaimer. The material that we present today is just informational, and we're not your CPA signing your tax return. We're not your tax attorney. So this presentation is intended to provide, general information. Do your own research and analysis before making any decisions. Consult your own CPA, tax attorney. We're very open. We're happy to get on phone calls with your CPA, with our tax advisors as well, to talk through any of the issues or questions that you may have. And so we're very open that way. But do your own research. Make sure you feel comfortable with any of these options that we're talking about today before you implement them. Okay, so this is what we're going to try to cover today as quickly as possible because we know everybody is busy. In part one, we're just going to talk about why plaintiff attorneys have this unique ability to control their income taxes. That's going to be part one. Then part two, how plaintiff attorneys can defer taxation on their legal fees. So we'll talk about deferring taxes. And then part three, we're going to talk about a proprietary, unique solution that allows plaintiff attorneys to convert their legal fees, their taxable legal fees, into tax-free income for the rest of their lives. So with that, I'm going to let Dan kind of take over here and talk about this first part.
Yeah, thanks, Craig. It's great to be here. Thank you all for joining us today. In this part, we're going to talk about what makes plaintiff attorneys unique. Why do you have this unique control? Before we get to that, of course, as an attorney, you can still use traditional planning options. This chart will be available in the materials that we'll send out after, but a lot of the attorneys we work with will use these plaintiff attorney unique strategies along with a 401k or an IRA. And so this chart, which again you can download after the webinar, just compares the contribution limits, the timing, the employee participation requirements, and other details about traditional planning options. So what we talk about today is not meant to replace these, it's really meant to supplement and enhance the traditional planning options that any financial advisor or CPA is familiar with and can talk to you about. All right, so plaintiff attorneys do have unique tax needs, as Greg already mentioned. You have irregular revenue streams. You have to front expenses, front the cost to fund your cases, and you have limited access to traditional bank debt because banks just don't understand the world of a contingency fee-based attorney. So what is unique to you as a plaintiff attorney is that you can control the recognition of your legal fees when you are taxed. And so contingency fee-based attorneys or any attorney who receives a referral fee on a contingency fee-based case has the unique ability to defer the receipt of contingent legal fees to future tax years. This deferral allows you to postpone the tax obligation until the year in which the payments are then received. In other words, you're taxed later, not now. And it's only available for contingent legal fees. So the underlying tax law that allows for fee deferral really comes from the seminal case Childs versus Commissioner. In this case, the IRS challenged an attorney who used attorney fee deferral and took him to tax court. The IRS lost in this case, and the court held that lawyers can defer the receipt of contingent legal fees and the taxation on those legal fees to future tax years. The IRS appealed, and 2 years later, Childs was affirmed without opinion in the 11th Circuit Court in 1996. In the private letter ruling issued in 2008, the IRS did cite the Childs case with approval, and since then there's been no formal attack directly on the Childs case. However, as with any tax strategy involving tax deferral, there's always some level of tax risk. And so, as Greg mentioned, you should always seek your own tax advice before implementing any strategy that we discuss in this presentation. So in part two, Greg's we're going to talk together about how plaintiff attorneys can defer taxation on legal fees, meaning what are the vehicles that allow you to defer taxes. And so the first option, which Greg will talk about, is a structured settlement annuity, which provides tax deferral. The second option, which I'll cover, is a deferred compensation plan unique to attorneys, which also provides tax deferral. And the third option, which I'm guessing very few of you have heard about, is called attorney fee saver. And we'll discuss this in detail in part three. And it converts taxable legal fees into tax-free lifetime income. So what we're going to do for the rest of the presentation is we're going to walk through each of these options and explain the pros and cons of each. We're going to start off by focusing on those first two options, which are the options which offer the tax deferral. So the first option, again, is structured settlement annuities.
Okay. So if you have heard of attorney fee deferrals, and thank you, Dan, for that, and feel free to jump in as I'm going through these. If you have done any kind of tax deferral for your fees, it's probably been through the use of a structured settlement annuity. These have been around since 1996, as Dan said, with that Childs case. And so many plaintiff attorneys that we work with have heard of structured settlement annuities and either like them or don't. But you've likely used a structured annuity for your client or one of your clients in the past, whether that's been for a minor or an adult that just needs lifetime income or kind of set income every month. Essentially, the process is exactly the same when using a structured settlement annuity to defer your legal fees. So, as you know, a structured settlement annuity is essentially a guaranteed annuity contract that's issued by a major life insurance company. There's about six or seven in the market. The companies that are in the market are the ones that you've heard of: Pacific Life, MetLife, USAA, Prudential. Um, who else? New York Life, Berkshire Hathaway, the large life insurance companies um, provide and offer structured settlement annuities for your clients and also structured settlement annuities for your fees if you want to defer your legal fee using a structured annuity. So the process to set up a structured annuity for your legal fee is exactly the same as it is for your clients. And so if you've done one, you'll remember that at the time of settlement, you need to decide how much of your fee you'd like to defer and how much you'd like to place into the deferred annuity or the structured annuity. And you have to come up with that payment schedule at the time of settlement. So if you have a $100,000 fee that you want to defer and you want to spread it out over the next 5 years, that language needs to be included in the release agreement between the parties. And the defense is essentially agreeing to fund those payments. And then in the next paragraph, they're assigning that obligation to make those future payments to the annuity company's assignment company. So the defense cuts one check to you for fees and costs and for what your client's going to receive that you want to keep this year. So they'll cut one check to your firm, and the portion that you're going to be deferring in the annuity, they would cut a check directly to the annuity company's assignment company, who then purchases an annuity policy from their parent life insurance company, like Pacific Life or MetLife, who then has the obligation to make the future payments to you or your law firm. So there is some defense involvement, and we'll talk a little bit about that a little bit later, just like there is with a structured annuity for your clients. The defense is somewhat involved in that there's language in the release agreement and they're having to cut a check directly to the annuity company. So let's talk about some of the advantages of the annuity-based deferrals. Of course, the main advantage is that you get immediate tax deferral of current income, meaning that $100,000 that you placed into the annuity, you're not taxed on until you receive those annuity payments back from the annuity company in future years. So it's a way for you to lower your current year taxable income, get into a lower marginal tax bracket, spread out your fee over 2 or 3 or several years or the rest of your life in order to get into a lower tax bracket, and have guaranteed payments coming to you or your firm. Another benefit is, of course, you get the tax deferred growth. These annuities do have an interest rate component. Right now, those interest rates are better than they've been in recent years because interest rates across the board are up a little bit. And so, we're seeing interest rates, depending on how long you defer it, from, upwards of 4 to 5% in some cases, depending on how far you want to defer out those payments. And of course, all of that interest is growing tax deferred as well inside of the annuity. So you get tax deferred growth as well. Another advantage is you don't have to, you don't have the required minimum distributions that you do in a lot of qualified plans. There's no contribution limits like there are in most of the qualified plans, like 401ks and IRAs, and that kind of thing. So that's a definite advantage. Most of these annuities are a fixed rate annuity. It's just a very simple fixed annuity that has a fixed rate of return that's guaranteed by MetLife or Pacific Life or whichever annuity company is that you choose. There are some market-based options now, and we'll talk about one in particular a little bit later. But there are other options where if you would prefer to have your annuity payments based on an underlying mutual fund that will go up and down in value and potentially get higher, returns than the fixed rates that come with these annuities, those are available as well. So the nice thing about these annuities is they're very flexible at the time you establish them. So we like to kind of talk about it like concrete. You're laying cement. It's very flexible, right? When you're laying it, you can do all kinds of different things, but once it's set, it's pretty much set. And so they're not very flexible once that wording's in the settlement agreement. Once you have that annuity contract that spells out exactly when you're going to be receiving those payments, there's not much ability to change that once it's set up. Um, Advantages, especially for those that are nearing retirement and want some more guarantees. The fixed rate annuities, they're not correlated to the financial markets. If there's another 2008 or 2020 and markets go way down, your annuities stay the same. They're guaranteed by the annuity companies that issue them. And again, these are the largest life insurance and annuity companies in the world.
Just a couple
Yeah.
comments. We did have a question. Again, there was a question, what was a typical fixed rate for the annuity? It depends a bit on the time horizon of the annuity, but right now we're seeing rates in the neighborhood of 4 to 5%. Again, depending on how far you defer it out. Just one thing to note as well is we see annuities being one popular use of annuities is if you just want to smooth out firm cash flows. You have a good case that comes in, you want to cover firm expenses, overhead, payroll for the next few years. That's one great use of an annuity is just so that you have some amount coming in to cover your fixed costs over the next couple of years.
Yeah.
All right.
Yep. And in that situation, if it is just going to be 2 or 3 years, the rates of return are going to be lower.
Yeah.
The longer you spread out the annuity, the higher the rates of return are going to be. So just know that. But of course, you're not doing this because of the sexy rates of return on these fixed annuities. You're doing it to get out of the higher tax brackets into lower tax brackets and spread out your taxation. So some of the disadvantages of these annuity-based deferrals, the rates of return are modest, compared to what the S&P 500 has been getting in the last year or two and that kind of thing. There are, as I mentioned, index-linked annuities that can benefit from the market growth, but do have that downside protection. We'll talk a little bit more about one of those options. Another disadvantage is taxes are deferred, but they're not eliminated. So with your clients, if it's a personal injury case, if they do one of these annuities, then of course all of the growth inside of those annuities is tax-free forever. With your fee, it's taxable to you, but you're deferring it, but you're not eliminating it. You're going to pay taxes on those payments when they come to your firm in the future. But hopefully you're in a lower tax bracket when that happens. As I mentioned, they are inflexible once they're established. There's really not much ability to change them. If you do have to access funds in one of these annuities, then you can reach out to us or whoever, and we can find a factoring company that will help you get a lump sum of cash for that future stream of payments. That does require a court order to do so. I've never seen a court really deny that, but there is a process that you have to go through if you do want to access cash inside one of these annuities once it's established. Let's see. So we talked about, so as I mentioned, most of these annuities are fixed, right? They're just fixed rate annuities. There is a unique option that I've been kind of alluding to, and that's called the ICE structure, which is a unique product that's offered by an annuity company called Independent Life. Independent Life is a company that's been around since about 2017. They focus solely on the structured settlement market, and their product provides the opportunity for growth, because it's based on an underlying mutual fund or index fund. And so with the I structures, your payments grow when the index returns are positive, and you also have what they call a participation rate, which means, for example, if the underlying mutual fund grows 10% in that year, you can have a participation rate on the I structure that you create for yourself that will multiply that by that percentage. So oftentimes, for example, if there's a 10% growth in the underlying mutual fund and there's 130% or a participation rate, then your growth will be more like 13% or something like that. So it kind of is an accelerator on top of the growth in the underlying index. In a year where it's negative, then your returns will stay at zero. You don't lose money. So that's kind of if you want something that has a little bit more, I guess, opportunity for growth than the fixed rate annuities, the I structure is a good option for that. As I mentioned, it's based on the bank. The underlying mutual fund that it's based on is the Franklin Bank of America World Index, which is the one that they use, which is supposed to provide long-term growth. or as they describe it, systematically investing in a volatility-controlled equity index of companies worldwide. So what's nice about the I structure is it does provide some inflation protection because the I structure will grow with the growth in the underlying index. Your purchasing power is a little bit protected there. This is just an example of kind of how the index would grow from year to year. If the index gain is like 10%, then you multiply that by the participation rate in the policy, and that's what they call the index credit rate, which just means you actually get a bump above what the underlying index produced that year. And then in a year where there's losses or there's zero growth, if there's a loss, then you don't actually lose. The insurance portion protects that. So your downside is protected, your upside is potentially greater than you can get with a fixed annuity. And there are other products as well that besides the I structure that will just, for example, base that growth in the annuity just on, a BlackRock fund or a Vanguard fund or whatever you choose. But in those, there is no downside protection. So if the market goes down, your payments are going to go down as well. So did you have something to add there, Dan?
Oh, we just had a question come in on annuities before we move on.
Yeah.
So how often do defense attorneys or insurance adjusters balk at paying the fee directly to the annuity company? And what are your options?
I would say not often. I mean, most of the time they're familiar with structured annuities because they've been doing them for injured plaintiffs. And so, there are certain casualty companies that just won't do it. Travelers, for example, is notorious. They just won't fund annuities for plaintiff attorneys that want to defer fees. Other than Travelers, I can't think of any off the top of my head, Dan, that just absolutely will not. Usually it's best to kind of let them know, at mediation or at some point that, hey, look, either me or my client may want to be deferring fees with an annuity. Oftentimes, the defense will have their own annuity broker that they want to bring in, and they can work with us. And so we will work in concert with their annuity person to make sure that they feel comfortable with the transaction, and you can still work with us to do whatever you want to do. In that situation, it just helps the casualty company feel better about the language and moving forward. So I'd say most of the time it's not an issue, but there are a few casualty companies that just have a policy against it. So
okay, great. All right. With that being said, Greg shared option 1. I'll be talking about option 2, which is a deferred compensation plan. In our work with attorneys, fewer attorneys have heard about this, but in the last couple of years, they seem to be gaining in popularity or notoriety. So an attorney deferred compensation plan is similar to the plans that executives at Fortune 500 companies use to receive and delay taxation on much of their compensation. And attorneys like you can establish a deferred compensation with a plan administrator that focuses on plaintiff attorneys. So it's a plaintiff attorney specific deferred compensation plan. I have a link here. If you want to deep dive on this option, when I send out the slides, we do have a webinar just on the deferred compensation plan that goes a bit deeper. So you can watch that if you would like. And the deferred compensation plan administrator is very similar to a 401k plan administrator in that the funds go into the plan. You have a menu, an investment menu that you can choose what you want to invest in. And then you'll have an online portal where you can see the performance of your deferred compensation plan. So some of the advantages of the deferred compensation plans is you get to choose the investment portfolio of your choosing, right? And ideally, it earns a higher rate of return than a fixed rate annuity. And deferred fees, if you, of course, earn market-based rates of return. There is downside possibilities, but there's also higher upside. The deferred comp plan administrator does actually have a fixed rate fund if you don't want any volatility, so you could choose a fixed rate fund as well. But generally speaking, most attorneys will choose an investment that is, in different mutual funds or whatnot. So one thing with a deferred compensation plan that's different than a structured settlement annuity is that technically a deferred compensation can be funded from your IOTA account. So you don't have to involve the defense, but the best practice is still to have the defense fund the plan directly and include language in the settlement and release agreement. However, the deferred compensation plan administrators do allow funding from an IOLTA account, whereas an annuity companies do not allow any funding from an IOLTA. With a deferred compensation plan, there's no minimum amount to a defer and there's no setup fee. With annuities, there's a small $10,000 or $15,000 minimum fee. And perhaps the one of the greatest advantages of a deferred compensation plan is that it has a flexible payout schedule. Unlike an annuity where you set it and it's set in concrete, the payment schedule, within a deferred compensation plan, the fees are invested in the plan and grow until you choose to withdraw the funds in the future. And so you don't have to decide at the time of settlement when you're going to get paid back. So you can spread out your taxes over many years if that's your goal to reduce the taxes paid. And so there is a rule that we call the 1 year, 5 year rule. This slide is a little complicated, but I'll talk about the 1 year, 5 year rule and kind of explain what that means. So if you fund a deferred compensation plan, before you receive any payment back from the deferred compensation plan administrator, you have to give them 1 year of notice. So 1 year until you can receive any payments from the plan. Then the fastest you could receive all of your money back from a deferred compensation plan is over 5 years in 20 quarterly payments or 20 quarterly buckets. Now, 1 year in advance, you can tell the deferred comp administrator, hey, I don't want that payment, or I only want half of that payment. And so, yes, 5 years is the fastest you can receive the money back, but you can spread it out 10 or 15 or 20 years, or as long as you'd like, as long as you just give that 1 year notice before that payment comes due, essentially. So in this example, $1 million fee is split into 20 quarterly payments. There's 1 year of notice, and then you can start receiving those quarterly payments. You can either withdraw all or of a portion of that quarterly payment, or you can roll it forward. Think of it kind of like to the end of the line. It's sort of like a conveyor belt. You either take it or it goes to the end of the line. So that's the 1 year, 5 year rule. And so a question we often get is, well, why don't I just contribute? Oh, go ahead, Greg.
Let me just hop in real quick on that. So with these deferred comp plan administrators, the deferred comp plan option, you can do this option, which is kind of it's kind of a I'm not sure when I'm going to want the money option. So you put it into the plan. It's more open-ended. And then you can let it grow until you give the plan administrator notice that you want to start receiving those fees. And there's always that 1 year notice requirement. However, there is another option. If you just want to spread your fee out over the next 4 years, you can tell the plan administrator at the time of settlement, I want, for example, 25% of this fee paid to my firm each January for the next 4 years. And that's an irrevocable decision. You can't change that one.
Right.
But you do have that flexibility to do that. So, and you can put some in that option and some in this more open-ended option with these quarterly buckets. But it just, like Dan said, it just gives you a little bit more flexibility with how you receive your funds. So I just want to make sure you knew about that, the ability to just do a fixed 3 or 4 year, 5 year option as well.
Yeah, sort of like an annuity. You can set a shorter payment schedule. We've had attorneys just push it to the next year, right? Or the kind of the default option is this extended payout option. So, yep, you do have some flexibility there. So one of the questions we often get is, why don't I just contribute to my 401k plan? Well, with the deferred compensation plan, again, and all these deferral options, you can control the amount of income you recognize, right? That's the great magic of fee deferral, is that you can control how much you pay taxes on. And if you're able to lower your taxable income enough, you may also be able to take advantage of the qualified business income deduction, which allows eligible pass-through entity holders or entity owners, so S-corps, partnerships, sole proprietorships, to deduct up to 20% of their qualified business income. So it doesn't work for everyone. There are phase outs, but if you can lower your taxable income low enough, it's a great deduction if you're able to receive it. And then unlike a 401k where you have to wait until 59 and a half to withdraw funds, and then at 73 you're required to take distributions, that doesn't exist in a deferred compensation plan. There's no need to wait till retirement, and there's no required minimum distributions. And the deferred compensation plan can be used to pay for case and firm expenses if you choose, and there's no employer participation requirement, and there's no annual contribution limits. So some of the disadvantages to the deferred compensation plan, again, returns are not guaranteed because you're investing in the market unless you choose a fixed rate fund. And the election to defer must be made prior to the settlement. And so our least favorite call is, hey, I just settled this big case. Can I defer my fee? Well, that election has to be made and an agreement has to be signed before the underlying release agreement is signed. So always keep that in mind. You need to make this election before you settle your case and sign the
Well, let me just clarify that. So you can settle the case, right? But before your client signs the underlying release agreement, you need to have made the deferral election with the plan administrator before your client signs and dates the settlement agreement. So it's not necessarily before you settle the case, it's before the final
the
release
final
agreement
release
is
agreement.
signed.
Right. Sorry. Yeah. And as I mentioned, the distributions are subject to the 1 year, 5 year rule. Again, you must give the plan administrator 1 year of notice before you can start receiving payments from your plan. And the fastest you can receive all of your money back is over that 5 year period. There are a couple questions that we can address here after this comparison slide. We'll just go quickly. Again, both an annuity and deferred comp plan, they defer taxes on current income. Annuities typically have a guaranteed rate of return unless you choose, an option like the I structure. Deferred comp plans, you're going to earn market rates of return unless you choose a fixed rate plan. The deferred comp plan has the flexible payment schedule. Annuities do not. And the structured settlement annuity defense involvement is required. In a deferred comp plan, it's not required, but it is best practice. And can you defer directly from the IOLTA account? No. In a structured settlement annuity, yes, it is possible in a deferred compensation plan. There's no limit or no minimum in a deferred compensation plan. I think it's 10 or 15,000 for a structured settlement annuity. The annuity companies keep raising it, and there's no maximum contribution. One question we have is, what is the disadvantage to funding a deferred compensation plan through the IOLTA? Greg, do you want to address that?
Yeah, no, I think anytime you're getting one step away from the facts of the child's case, then I think it's just a tax risk issue is the only thing. The child's case was a case where the attorneys used an annuity-based fee deferral. And so the language was in the release agreement, all of that kind of thing that we went through. And so the plan administrators feel very confident that in their legal authority that if you have signed a deferral agreement with the plan administrator before your client has signed that final release agreement, or before you have a ripened economic interest in your fee, if you have irrevocably, deferred your fee to the plan administrator, then for them, they're okay with the funds going to your IELTS account and then from there to the plan administrator. Um, we're just telling you that I think it's probably safest from a tax perspective to stay as close as you possibly can to the facts in the child's case. And so in that case, the defendant sent the funds directly to the annuity company. So if possible, and you have a defendant that's willing to have them send the funds directly to the plan administrator with a little bit of language in the settlement agreement, that's probably best. But the deferred comp plan administrators and their legal counsel feel like it's just fine for you to have it flow through the IELTA account if you've made that deferral election with the plan before your client signs that underlying release agreement. So that's
Yeah,
the
and
distinction there.
the deferred comp administrators do have tax opinions that you can review on these different points. All right. So how to get started? Greg already talked about with the annuity. It's very similar to with your clients. Language needs to be inserted into the release agreement. So you have to make that decision before, before settlement. The defense will have to sign a few documents, etc. For the deferred compensation plan, again, you must sign an irrevocable election to defer fees before you have a ripened economic interest. Again, before the final release agreement is signed by the client. However, you can set up your deferred compensation plan at any time, even if you don't have a case. So that's what we always recommend for attorneys choosing this option. Get it set up, get it ready to go. When a case comes along where you want to defer fees, that's when we make that election on that case, and so there's no delay on that side.
Yeah. There's no fee to get your plan established.
Right.
So there's no reason not to get your plan established and ready to go. Even if you never use it, there's no obligation to use it, even if you establish it. So, and And just on that point of fees, we haven't really talked about that. With the
Mm-hmm.
deferred comp plans, there's really two plan administrators that we use that we feel comfortable with. One is just a flat 1% per year of the amount that you have in the plan. Um, and then they have a menu of investments that you can go in and pick from, different index funds that have very, very low expense ratios. And so that's about 1% per year. The other one is also 1% per year, but then their investment, you would use our firm or another firm to manage the funds inside of the plan. So with that one, you have the 1% fee plus the investment advisor fee on top of it. So that's usually maybe closer to 2%. And so give us a call and we'd be happy to chat with you about the differences between those two plans. They're very similar. They manage the funds a little bit differently, and there's a few other differences. But in terms of fees, which is a question that you often will have, of course, usually it's 1% with the one plan or 1% plus your advisor fee with the other. With the annuities, there's no out-of-pocket cost for the annuities. With those annuities, there's a one-time commission paid to the settlement planner that helps you implement it. And so that's all baked into the annuity illustrations that we send you. And so if we send you an illustration from MetLife, then the commission is already baked into that illustration. And beyond that one-time commission that's paid, there's no ongoing fees with the annuity option. So,
Yeah. Great questions. One question we also have, do you put all the fees into the same plan? So every case you defer, you can make a different election, whether it's timing, you can choose different investment menus. So they're all kind of treated unique. So if you want to be aggressive with a certain portion of your fees and more conservative with another case that you defer, they are distinct in that way. So this is just a quick, Greg mentioned we're happy to meet with you and forecast kind of what this looks like. Our financial planning software has what's called a Monte Carlo analysis, where it runs 1,000 different simulations. And this just shows that after tax investing compared to pre-tax tax deferred investing, usually pre-tax tax deferred investing wins. But we're happy to run an analysis for your case using our software to show you the expected outcomes of deferring fees, or why don't I just take a lump sum and invest or something, right? So we're happy to always do that.
yep.
All right, we're on to part 3, which is that third planning option of how you can convert taxable legal fees into tax-free income for life.
Okay, well, I can
Go ahead. Yeah.
I'll talk a little bit about this, Dan. Feel free to jump in.
Okay.
I feel like with this one, I need to start off just letting you know it's going to be a little frustrating on this presentation as we go through it. The Attorney Fee Saver is a proprietary product that we have partnered with a group that developed it to be able to offer to the contingency fee-based attorneys that we work with. And so we're able to talk about the benefits and kind of give you a 10,000-foot view of kind of the general overview. But they require that attorneys that want to use it sign a mutual non-disclosure agreement, an NDA, at which point we can really dive into the nitty-gritty of exactly the flow of funds, how it works, work through an option with you, with your particular information. And so, you might be thinking, well, this is really kind of light on details, and that's because we can only be light on details until we have that signed NDA. So, but with this option, it's really by far the most powerful option if you qualify and if it works for you. So basically what the Attorney Fee Saver strategy does is it combines the fee deferral options that we've just talked about. So that can be either the annuity-based fee deferral or the deferred compensation plan fee deferral option with an executive benefit plan using split dollar permanent life insurance. So split dollar permanent life insurance has been around since the 1950s. Many business owners use it to defer taxes and to beef up large permanent cash value life insurance policies that they can then draw from in the future in the form of loans from that cash value. And of course, a loan from a cash value life insurance policy is tax-free. And so the Attorney Fee Saver program combines attorney fee deferrals that pay into your firm over usually between 7 and 10 years, that then flow into the firm and then are used to fund essentially a large permanent life insurance policy for you as the business owner that then grows and over time builds to where there's a large cash value life insurance policy that you can then draw from and take tax-free loans from. Okay, so that's the high level overview. Um, so in order to be able to use this option, of course, there are some requirements. You have to meet certain eligibility requirements in order to do it. Um, let's see. Dan, do we have a slide on that? Um, let's see. I kind of went through a lot of that. Let's see. So who's eligible? Maybe Dan, maybe go down to the next where it says who's eligible. Um, yeah.
Yeah, just a note that one of the advantages of the executive benefit plan is not only that you can take tax-free income from the policy, but you have a substantial death benefit that benefits you and protects your loved ones. And so this is, yeah, so
Yeah. Yeah, because it's
typically, go
yeah,
ahead.
go ahead. Yeah, sorry, Dan. Because there is a life insurance policy, there's obviously a death benefit associated with it. That's one thing that the annuity option or the deferred comp plans obviously don't have. And so, that's another added benefit. Um, but who's eligible for this program? You do have to meet certain requirements. You have to have an average annual income of about $500,000 or more. That's not a hard and fast rule, and we know that contingency fee attorneys' income wildly, you know, goes up and down from year to year. But generally, if it's around $500,000 a year or more, is what they're looking for. If you have a net worth of about $1 million or more, that's generally best. And then you do need to be an equity owner in your firm because your firm is the one that's going to be taking out the life insurance policy on you as the owner of the firm. So you need to be an equity owner in your firm, ideally with less than 5 or 6 owners with you as part of that firm. And then, of course, because there is a life insurance policy involved, you need to be at least insurable. You don't have to be Iron Man, but you do need to be insurable. In other words, if you were to go and apply for a life insurance policy, the life insurance company is going to insure you. So, again, we realize that this limits the universe of attorneys that are able to use this program. So if you don't meet these requirements, don't worry. Obviously, you can still use the annuity option or the deferred compensation plan. The unique thing about the attorney fee saver is just that it eliminates taxes now. Dan, maybe if you want to go to the next slide, it eliminates taxes now, right? Because you're deferring legal fees on current year income and then converting it into tax-free income in the form of policy loans from a large life insurance policy. So you're able to defer and eliminate taxes on your fee now and then eliminate it essentially forever. So you can use it in conjunction with an annuity. So for example, let's just take, well, we're going to go through some examples here before I get ahead of myself. I always do this and it drives Dan crazy. I get way ahead of myself on the slides and then I end up repeating myself. So the other advantage is it does provide tax-free benefit. There's a death benefit, of course, associated with those life insurance policies that will benefit your firm or your loved ones or whoever you name as beneficiary. So I know that's really kind of light on the details, but want to talk about the attorney fee saver and just give some maybe case studies. And one thing to note about the attorney fee saver program is that you generally need about 10 years from the start of the program until you begin taking that tax-free income. And that is what we call the accumulation period. And so that's you're feeding your policy, your life insurance policy through either firm income or through an annuity that's paying into your firm each year that you've deferred on a case that's going to fund your cash value life insurance policy. And usually that takes about 10 years. And so you need to keep that in mind. So that's what we call the accumulation period. But during that accumulation period, you're really growing. You're really able to grow this unique and robust tax-free income stream for life. So the more years you have between when you start it And when you decide to start taking that income, obviously the greater the benefits, just because of the time value of money idea. So let's go through a few case studies. Um, so let's assume most of the people that we're working with on the Attorney Fee Saver program are between 35 and 65 years old. So we've got three case studies here. First, we're going to start with a 40-year-old attorney. Okay. So what we're going to with these examples, well, we'll go through each one. With this 40-year-old attorney, you have the average annual fees deferred are $100,000. So if we're saying it's a 10-year accumulation period, then over those 10 years, that's $1 million that this attorney will have deferred into the program. And he wants to start taking payments, taking that lifetime tax-free income from the insurance policy or the annuity, I'm sorry, from the life insurance policy at age 55. And we're assuming that he's going to die at age 90. Okay, so we're just going to compare this with the other options. So if that attorney were to take that same $1 million and just, or that same $100,000 each year as a lump sum, then the total income he would have after taxes, you can see there, and then you can see all the lifetime taxes that he will have paid on that. If he would have deferred it with an annuity, it almost doubles the total income he would have received, and the lifetime taxes he would have paid would also increase a little bit, but he would have, it's a much better deal than taking the lump sum. So that's the kind of the structured settlement annuity comparison to taking those funds as a lump sum. The deferred compensation plan is similar, but it's usually a little bit better just because we've assumed that rates of returns are a little bit better. And then we compare that to the attorney fee saver, which, as you can see, the total income that this attorney will have received after taxes is about 4 times greater than it would have been in the deferred comp plan or the annuity. And then in addition to that, one thing that the other options don't have is that death benefit at age 90. So if you look at that total death benefit and the total value up to this 40-year-old attorney who's deferred $100,000 a year for 10 years, the total death benefit is about $10 million, and then he has access to annual tax-free income of about $234,000 a year, which means his total after-tax benefit is about $18 million between the combined income plus the death benefit. So that's a very typical, actually, example of a 40-year-old attorney who's deferring on average about $100,000 a year. And so this can be done just with normal. I mean, he could say, okay, I'm going to defer $100,000. I'm going to allocate $100,000 a year to this program and just take that from, current case, current business
revenues.
income. Yeah, just from revenues. Or if he's 40 years old and he gets $1 million fee from a great case, he can put that $1 million into an annuity that pays to his firm over the next 8 or 10 years of about 120 or whatever that annuity amount is. And essentially, in that situation, he will have pre-funded this whole program with one big fee. So,
Yeah,
go ahead.
Yeah, just a couple notes here. Like for all of these different scenarios, we used conservative rates of return, right? These are not, we try to be conservative in all these estimations. And I just think, one of the huge benefits is this annual income after taxes, right? Because it's received tax-free, $234,000 compared to $35,000 in a lump sum or these other options. It's really compelling, right? It's a really compelling option, especially where future tax rates are uncertain. That if tax rates were to go up, that would only make the attorney fee saver option even more compelling because those loans are received tax-free. So
yeah, and that's the beauty of a cash value life insurance policy is loans taken from those policies are tax-free because it's a loan. And then you don't have to pay those loans back because when you pass away, the death benefit on the life insurance policy pays off the loans from the life insurance policy. And then what's remaining goes to your named beneficiaries. So,
yeah.
So that's for oh, go ahead.
You say I just say, yeah, we have about 10 minutes left, so we'll go faster through these second two options.
All right. So these are essentially the same, just with different ages. So the first one was a 40-year-old. This is a 50-year-old. So if you're closer to my age and you still want to do this, you have plenty of time. With this option, rather than $100,000 allocated to this program every year, it's $150,000. So the total fees that were allocated in this situation were 1.5 million instead of a million with the 40-year-old. So this 50-year-old starts this process at age 62. He's going to start taking those tax-free loans from the policy. You can see, again, the comparison with taking it as a lump sum. If he would have done this just with the structured annuity, if he would have used a deferred comp plan, of course, it's much better than a lump sum as well. But with the attorney fee saver, what you have is a substantial increase in the total income after taxes as well as that death benefit. So in the situation with a 50-year-old that's deferring about $150,000 per year to the program, at age 62 until age 90, the annual income he will be able to take from the program is about $255,000, and that's after taxes. So the total tax benefit or the total benefit to this attorney is over $12 million. And he's only deferred $1.5 million. So it really magnifies it.
Yeah, one thing to note here is with this option, you don't have to take $255,000 a year in income. If you have other income coming in, you can take more. If your plan supports it, you can take less, and so it's very flexible. This is just saying you could take an average of $255,000, but you don't need it that year. You take less, your plan's going to grow that much more. Or if you need a little more in that year, it is flexible that way as long as your plan can support it. So.
No, and that's a great point, because essentially what you have is this just gigantic cash value life insurance policy that you can draw from as needed.
Right.
And, so yeah, that's annualizing it until age 90, but you can take it whenever you want.
Right.
So now let's say, okay, you're 60 years old. All right, well, am I too late? No, you're not too late. So with this one, rather than putting in 100,000 or 150, we're saying, all right, because you're a little bit older, we need to beef it up a little faster. So you're doing $200,000 a year. So over those 10 years, you will have put away $2 million, and you're going to start taking that at age 70. Okay. So you can see the different values of comparing it with a lump sum, an annuity, and a deferred comp plan. With the attorney fee saver, again, it's about a 4x greater than even 2 or 3x greater than the lump sum, about double or 3 times better than the annuity. And then at age 70, you can start taking you can have about $272,000 a year until age 90 that's completely tax-free. So you can see what the total after-tax benefit is there. So again, if you meet the requirements, if you own your own firm or an owner in your firm, if you're insurable, if you meet the net worth and the income requirements, it's really to your benefit to sign an NDA. Let's get you all the information. Let's get on a Zoom call with our team and our CPAs, go through exactly how it works, see if it's going to work for you in your situation, and then you can have all the information you need to make that decision. But just to kind of recap all of these, or to recap this scenario, the attorney fee saver really does outperform any of the other suggestions or any of the other options that you have. Generally, it's about 3 to 6 times more income than the other options. It works for attorneys at different ages, at different income levels. And again, you have that added benefit of the death benefit associated with it as well.
And you can put more into the plan. If you get a great fee and you want to, the benefits and the results are magnified if you can put more into the plan, right? So just
and
compounds.
And what most of the attorneys are doing is they have a good fee and they're like, okay, look, I want to maximize this fee. So if it's a $500,000 fee or $300,000 fee or $1 million fee, you can pretty much pre-fund this whole program for the next 10 years with that one fee. Or you pre-fund the first 4 years of the program, and then you get another good case and you fund the rest of it. And then it's basically done. You've funded it. It's on autopilot. You don't have to worry about it again. So, of course, the attorney fee saver program is supported by tax law. The underlying strategies have been around for decades. I mean, we're talking about those fee deferral options that we went through earlier, as well as, cash value life insurance, which has been around forever. There is an opinion letter from a leading tax law firm on the attorney fee saver program that we are happy to send you once you've signed that non-disclosure agreement. And then, as I mentioned, well, I haven't mentioned this yet. There was an article that we wrote in the Practicing Law Institute about a year ago in March of 2024. There's a link to that article on the screen here, and we'll are we going to be emailing out these slides, Dan, or we'll email
Yeah,
out
we'll
this
send out a
link
link
as
where you
well?
can download
Okay.
these different materials.
Yeah. Really, the best way to learn more about it, as I mentioned, is to just give me a call, book a call with me. I just need to gather some basic information, nothing, no personal information, but just basic information about you and your goals. Then our team can create the analysis. We then get on a Zoom call to go through exactly the flow of funds, the process, exactly how it works. And then you can, get your CPA, your tax attorney, whoever involved to make sure that everybody feels good about it. And then we can kind of move forward. So, but again, there is that NDA that is need to be signed before we can really get into the details. So I apologize for being kind of vague about the details, but those are kind of the restrictions that we're under in order to kind of talk about it. But we wanted to at least expose you to it, let you know that there is that option, and it is a really powerful option. So happy to chat with you more about it as we move forward. Um, we're pretty much out of time, Dan. Again,
Yeah.
just on that next slide, we kind of talk about these three. We got the structured settlement annuities. You've got the deferred comp plans, and then if you qualify and it works for you, the attorney fee saver program as well. I'm happy to chat with you about any of these options, the annuity, the deferred comp plan, or the attorney fee saver. The easiest way to do it is usually to just find a time on my calendar that works for you. It can be a 15-minute call or a 30-minute call, whatever you want. We'll talk about your situation, answer any specific questions that you have, and see what makes the most sense for you. But just to kind of wrap it up, like Dan said, of course there's the 401ks, there's the SEP IRAs, there's all of those things that I think you should be using as part of your overall tax planning strategy. But because you are a contingency fee-based attorney, you do have access to really unique options that other attorneys do not. So we're happy to meet with you, explore those options, and go from there. Um, let's
Yeah,
see. Yeah.
I would just say, Greg is happy to get on, just again, talk through those options. He's, it's not going to be some high pressure sales call, just like this. We're going to explain the details.
Right.
And then our team, we have a financial planning team, CPAs, we'll prepare whatever projections you want. If you're interested in annuity, we can forecast that. If you're interested in deferred compensation plan, we can forecast that. Or a fee saver, we can prepare projection for you there as well. So again, just you have all these really powerful tools, and we want to do whatever we can to just show you a personalized, like, what does this look like for you? Right. So
Yep.
congratulations. You made it to the end of the
Yes.
presentation. But
Thank
Greg and
you.
I
Yeah.
are certainly always happy to chat about this. This is our phone number and email addresses are on the screen. I did see a couple questions from Kevin and others. I'll reach out directly to, because we're running out of time with those questions. I just wanted to acknowledge that I did see those questions come in. If you have any last minute questions, you're welcome to send those in the chat or the Q&A, but I will respond to those after we wrap up here. But mostly want to thank everyone for joining us today. Again, we want to be a resource for you and for your clients. We are going to try to do these webinars on a more consistent basis. And so the plan is in April to do another webinar and kind of every couple months as well on different topics. So if you have any feedback, if there's anything we can do to make this more valuable, more helpful, that's our ultimate goal, is to make these something that you want to attend and that they're helpful. But Greg, any final parting thoughts?
Nope. Appreciate it. That's our email addresses. If you want to jot those down, feel free to email or give us a call.
Yeah, and
Um,
we'll send out an email to everyone who registered that just has a link to a web page where you can rewatch the presentation, you can download the slides, you can download that retirement plan comparison chart for 2025, and you can also book a call on that page as well. So in the meantime, if you have any questions, reach out, and we look forward to chatting with you again in a couple months. Thanks everyone for joining us today.